evening, everyone, and thank you for joining the American Australian Association and SMATS Group for tonight's webinar, where we're here to discuss all things tax related as an Aussie expat. My name's Libbi Swan, and I'm the Director of Government Affairs, Arts and Operations at the American Australian Association. We were founded in 1948 and have provided an important forum for collaboration and exchange between the institutions and people of the United States and Australia, from US presidents and Australian prime ministers to leaders in sport, education, culture, and the arts. The AAA is proud to support the next generation of leaders through our scholarship program, which has awarded $14 million in scholarships and grants to over 900 graduates, veterans, and artists. Tonight, the AAA is proud to partner with SMATS Group to bring you an update on all things tax related. SMATS Group are international leaders in providing Australian taxation, finance, and property investment services to Australian expats, foreign investors, and intended migrants, with its tax division growing to become one of the top 100 accounting firms in Australia. SMATS is also a proud benefit partner to the AAA individual membership program and has offered exclusive discounts and benefits to our individual members, many of whom I know will be watching tonight. I would like to welcome our expert this evening, Steve Douglas. Steve is a chartered tax advisor, fellow of the Tax Institute of Australia, and registered tax agent. He is the co-founder and managing director of Australian Taxation Services and executive chairman of the SMATS Group of companies. As an expert and avid property investor himself, Steve discovered a niche in the market to provide special tax services to Australian expats, property investors, and retirees. Steve has a passion for education and knowledge sharing and is a regular presenter on taxation and property market matters affecting Australian expats, property investors, and retirement tax planning. Please feel free tonight to send through any questions that may come up in the chat, and we will do our best to answer as many as possible in the Q&A at the end. And I know Steve has done his best to answer as many of those that were sent through in advance in the presentation. So we'll do our best getting through those. And without further ado, I'll hand over to Steve Douglas. Welcome, Steve, and thanks for joining us tonight.
Thank you, Libby. It's great to be with you, and hello everyone over there in New York. Unfortunately, I won't be there in presence as we live in a new age, and New York's one of my favourite spots, so I miss coming there. We're normally there at least 2 or 3 times a year, but unfortunately, I've been blocked out for the last couple of years, but hopefully we'll change that. But tonight, I'm going to be as close as we can be and take you on a lovely journey through taxation, always everybody's favourite topic. So, it's excited me for many, many years, and hopefully we can part some really good knowledge and information for you all. So if you're ready, we'll start it off and enjoy the ride. Okay, so hopefully we'll kick it off, and tonight we're taking you on a journey of expat taxation. We're calling the Aussie Expat still the luckiest person on earth, because it's a long time. I wrote a book which we're going to share with you for your participation and appreciation of that, and it's called the Aussie Expat, the luckiest person on earth. And I wrote that way back in 2004, and I've done a couple of upgrades since then. But so much has changed since then. So we're doing a recap tonight and having a little bit of a nostalgia run and seeing if you are indeed still as lucky as you used to be, and what you can do to still get the most out of your time abroad. And that really is the key. If you are going to venture offshore, if you are going to go and take the risk and the hassle of leaving your family, leaving your friends, seeing what the world does, it's important to make sure that you achieve some good financial outcomes and you go back to Australia in better shape. And that literally is what the book's all about. As with all things, especially because you guys are Americans and every second person's a lawyer, I have to put a disclaimer up. So, obviously, what we're telling you tonight is factual and real, but it's still opinion. And it really is, when it comes to taxation, a situation where you need to get close and personal advice and make sure that you get to have your circumstances properly reflected. So please, reach out. We're more than happy to assist you in any regards with, specific questions, specific requirements. And, we're very, very easy to get hold of and love to support you. I'm going to get stuck in by, like I said, taking a little bit of a time journey back. And I thought, I'll take the opportunity to go back to 2004 and compare how things have changed over that time for expatriates. Now, these are the key elements that have changed, and some of them good, some of them bad, but, the first couple not so good. In the good old days, we could claim our travel costs. And that used to be a fantastic thing. If you had a rental property back in Australia and you flew back for, for Christmas and you use that as an opportunity to inspect the property, you could claim those costs of travel either in full or in part. But it got abused, unfortunately, by many people that didn't really do the travel or didn't go and inspect their property, but still try to claim. So that got taken off us in July 17. We also used to be able to claim depreciation if you bought a property off somebody else, not a brand new development. And again, unfortunately, that became a little bit abused again. And so people were double dipping. They were having the original owner claim, and then the new owner would get a bogus depreciation schedule and claim a whole bunch again, which was totally against the spirit. And the government, in the same time in July 17, changed it. And they said, quite rationally, they said, look, this abuse is quite strong. This abuse is too hard to chase. It's too expensive to chase. So their solution was, let's just take it off. They've lost the right. Unfortunate for those that had done the right thing, but I can understand the logic of the government in saying this is an easier way for us, and we tried, but they didn't respect it. Personal tax rates have changed. The starting rate was 29% as a foreigner when you were back in 2004. That has lifted to 32.5%. So it has gone up from 29 to 32.5. Not significant, but certainly still, to be monitored. But the top rate has reduced from 47 to 45. But more importantly, the level that the top rate kicks in has increased substantially from 62,500 in 2004 to now 180,000. So that's become a lot fairer, not just for expatriates, but also for people in Australia in particular, that wages have been very strong in Australia. They've grown progressively. So to have that top tax rate kick in now at 180,000, literally less than 5% of the Australian population are paying the top tax rate. Whereas when it was at 62.5, it was a substantial, more than that. And so we've seen a great shift in fairness of personal tax rates over the journey since 2004, something that I think is not only necessary, but certainly highly welcomed. And that's been fantastic. Unfortunately, a lot of people still think Australia as a 50% tax country. It's not that bad. The tax rates are very favourable, and with sensible planning, it's surprising how good an outcome you can achieve on return to Australia. In 2004, if you were a little bit of a naughty person and not lodging your tax returns, and and you didn't have any tax to pay. Now, basically, what it means is that as an expat, you don't have to lodge a tax return in Australia generally, unless you have a rental property in Australia earning income from that rent. Now, it's not about whether the rent is more than the expenses. It's just the fact that you earned rent that makes you need to lodge the return. Now, the fact that, if you have interest and expenses, that you might end up in a loss, and that loss makes you non-taxable, doesn't, overwrite the requirement to lodge the tax return and tell the ATO of that situation. In fact, if you are in a loss, it's more to your advantage to lodge your tax return every year, because that loss carries forward, as we'll talk about shortly, to offset future income tax on the rental, on the capital gains, or indeed future tax on salary when you return to Australia. So it's very much in your favour. But in 2004, if you did have a rental property with a mortgage and you were breaking even or making a loss, if you had forgotten to lodge your returns and then you caught up with them as a block, it was, not going to be charged any fees. No tax payable usually meant no fee payable. But they've changed the rules to ensure that, better compliance is in effect. And now, if you're not lodging your tax return, there's a fine of $1,050 per person per year that you have not lodged. Now, a lot of people don't think they need to lodge because they're overseas. That is not the case. If you have a rental property, you must lodge. And you can see that $1,050 is per person. So if it's husband and wife, that's $2,100 a year that you might be charged. Now, we've got a very good relationship with the ATO. If we go to them and say, look, sorry, we forgot, here it is, then it's likely you will not be charged. Can't guarantee it, but very, very rarely does that occur. So if you are forgetting to lodge, come to us. We'll help remind you. We'll help you get it sorted. We'll do it quickly and easily and make sure you're all up to date. Now, capital gains tax, has always been an issue in Australia. It was obviously way back in the days of 1985. It was no capital gains tax in Australia. It was brought in 1985. And then later on, it was changed, to reflect, that whatever gain you made was 50% tax-free. Now that replaced what was the old regime, which was inflation-free, everything above inflation taxable. So it became a simpler system. You didn't have to worry about indexation, etc. But in 2012, the Labor government, as literally their last act of parliament before they lost the election, passed a law saying that if you're living overseas as an expatriate or a foreign investor, you do not get that 50% tax-free anymore for the period that you're living overseas. Now, if you had a property prior to 2012, you need to get valuations, and the past gains will get that discount. But if you've bought since 2012 and you're overseas when you sell, you're going to be taxed on the full gain. Now, if you go back to Australia, you will pro rata that 50% discount for the period that you are in Australia versus the period that you've owned the property. So one of the key things that we'll talk about later is that, if you are owning a property, don't sell it till you go back. Don't sell it until you've been back as long as possible. And therefore you get more and more as a pro rata basis of that 50% discount. So for argument's sake, if you've owned a property for 10 years and then you go abroad for one, if you've been abroad for 10 years, and you go back to Australia for one, you'd get 1/11 of the 50%, then 2/12, 3/13. So the longer you live in Australia, the longer you own that property, the more of the 50% you will get. So I highly recommend you do that. One of the big horrible changes, and this one was brought in by the Liberal Party, and it still perplexes me as to why they did this. We fought it very, very hard, but we couldn't get them to change their mind. But the principal residence exemption, which has always been a right of entitlement basically for every Australian. If you had lived in your house, in Australia, or if you'd gone abroad and lived previously in your house, it was a capital gains tax free asset for that period of occupation. And there was an additional 6-year availability under the temporary cessation rules that if you went overseas, for instance, stayed overseas for 5 years, rented out your former family home during that period and came back within that 6 years, then it was if you were living in that house the whole time and you wouldn't pay tax. If you lived in it, for prior to departure, rented it, say, for 8 years and then came back, then you'd get 6/8 of that period would be tax-free. Unfortunately, the Liberal government changed it to say that if you sell that property while living overseas, it's as if you never lived in it for tax purposes. So what that means is not only do you lose the ability to get that 6-year benefit, but you lose all of the benefit that would be applied for the period you lived in it. Now, this is a terrible rule. And what it means is, if you can imagine, if you had lived in your home for 10 years and then you moved to New York for just a year and then sold your house, even though normally you would get it totally tax-free, because you sold it whilst living in New York, you would end up paying tax on the full gain as if you had never lived in that property. Now, you'd still get the 50% discount for the period you were in Australia, but you wouldn't get the 100% discount. And to me, this was a terrible change. And we're still hoping that we can one day change it back, but it makes no sense. It's irrational and it's quite atrocious. Now, the irony is that all you have to do so that it does not hurt you is don't sell until you're back in Australia. So if you've ever lived in a home and you keep it, please do not sell it until you're living back in Australia. Now, that's not living back in the house, it's just living back in the country. So it's important that you do that and you remember that as a safeguard. Also now, if you're living overseas and you sell a property, they don't trust us like they used to. Back in 2004, if you sold the property, there was no tax implications at the time of settlement and you were just expected to lodge your return. But what's happened is property values have gone up, capital gains have gone up, and the government is less trusting than they used to. So what they do now is they have a withholding tax of 12.5% of the purchase price any time that a property is sold for more than $750,000. So if you sell it something under $750,000, this will not apply. But when you go and sell a property for $750,000 or more, the settlement agent or the lawyer will ask you, are you a foreigner or are you an Australian? And you have to get what's called a clearance certificate. Now, again, government being government, they made it difficult. Instead of only the foreigners having to prove, they made everybody in Australia have to go and get a clearance certificate when they sell. So every single resident still needs to get a clearance certificate, although it's an automatic issue because they are living there. But if we're overseas, the government will require that lawyer to deduct 12.5% of the sale price. Now, that is not your tax bill. It's just an amount held in advance of you calculating your tax bill. So they'll keep that, and then you'll lodge your tax return. And if it's more, you'll pay extra. If it's less, you'll get a refund of the difference. Now, if you thought that 12.5% was going to be substantially more than the tax payable, you are allowed to make a variation request and say, look, I think the tax will actually only be 5%, for example, and they would reduce it to the 5% as a withholding tax, but then you would still be required to lodge your tax return and calculate it formally, and then an adjustment would be made as applicable. So this is what a lot of people don't realize. They think, oh, it's all great, I might just go sell my property, but you forget that 12.5% is going to be withheld, and you'll need to come to us and assess what that gain is and then work it out. Now, we always recommend, because capital gains tax has become more expensive by the reduction of the 50% and also the removal of the residence exemptions, we strongly recommend that before you ever sell your property, you come and get a tax calculation done so that you know what you're up for. A lot of people think, oh, great, I'll sell my property, make some money and use it for something else. But when they end up doing the transaction, so much sometimes can be lost in capital gains tax that it would have been more effective to borrow rather than sell, because more money was released, for instance. Rents have stayed pretty much the same over that period. So the market itself is pretty much it. 2 to 4% net rental is still the mark that we would do. But what has changed massively is, you can see back in 2004, the RBA official rate was 5.25. Now, as a general rule of thumb, the banks always put about 2% onto that. So interest rates that you were borrowing back in 2004 were around about 7.5%. Now, today, the RBA rate is 0.1, and the banks are lending at around 2.5 to 3%. Now, it used to be that as a foreigner, you would get the same interest rate as someone being an owner-occupier in Australia. But about 4 or 5 years ago, they changed that to say, oh no, investors pay a premium, owner-occupiers get a discount. So that's changed too. So you should be expecting to pay between about 2.8 and 3.5 on your interest rates, but that's still substantially less than what it was way back in the day when it was around 7s and 8s. And I think I can recall the highest in my memory is about 9%. But I don't think we're going to return to those very expensive interest rate days. But we're certainly at the lower end of the scale. I don't think we're going to get any lower than this. And particularly if the RBA is at 0.1, it's not really much wriggle room down. So we are expecting rate rises, and you need to be mindful of that. In terms of finance, again, in 2004, I used to love my job. I'd say to people, hey, go buy a property, buy whatever you want. As long as you had your 20% deposit and your 5% for cost, which is what's generally required, you could go literally and get a loan anywhere. These days, you've got to go and get a pre-approval because it's very hard to get finance. And particularly if you try to do it yourself and you just walk into your favorite bank and say, hey, I live in New York, can I get a loan? 9 times out of 10, the teller would just say, no, too hard, I'm going to say no. Now, the truth is there is lending available for you. It is good lending, it is affordable lending, and it is higher volume up to 80%. But there's only a few lending options available. So you need to know where to go. So that's great for us because we run a finance broking business too. And so, you need us to go and find the right spots, and we are experts at that craft. But what it does mean is that you really, really should make your finance your starting point of the journey if you are looking to buy. And the reason is you can't guarantee that you will get the loan that you want. You need to establish your budget prior to going shopping and get a pre-approval. Now, that is particularly true at the moment in the likes of Sydney and Melbourne, which are very, very high auction environments. So most properties get sold at auction. You are not allowed to bid at an auction if you can't afford to purchase it. So if you need finance, you have to have a pre-approval to get in and purchase it, because an auction is a, basically cash sale. So you don't want to take a chance, put a deposit down at an auction to find out what you thought you could get isn't available and then lose your deposit. So you need to be very, very careful about that. you've got a situation where, look at the average price. I mean, I've loved my job. We've helped, literally tens of thousands of people buy property, particularly their future home, which we'll talk about. And you can see in 04, you could buy in Sydney, the median average at the time was 515,000. It's now 1.5. Now that's a significant uplift. It's tripled over that 18 years. Now in Australia, there was always the general rule that it would double every 10 years. I must say that I'm not a subscriber to that. I do think that we've got good growth ahead. I still think Australia is one of the most affordable luxury markets in the world and the best livable, affordable accommodation around. But what I do believe is that I don't think we're going to see it go from 1.5 to 4.5, but I do think we'll get at least the same quantum growth. So I would give you a prediction that you're probably going to make about 1 million plus in the next 15 odd years, which is still a significant sum. It won't be as high a growth rate as we're currently experiencing, that's for sure, but it will still be a nice, generous return. But one of the things that has happened, and which I think is one of the dark secrets of Australia, is the state governments are smashing people on stamp duty. So if you imagine that same house back in 2004 for 515,000, we would have paid $18,000 stamp duty. Now, stamp duty is literally a state government charge that just goes plonk, put a stamp on a piece of paper to allow a transfer to occur. That same house is now worth 1.5 million, and the stamp duty is now $67,000 for the same house. Now, it's the same task of just plonking a bit of ink on a bit of paper. But this is a terrible situation in Australia, where you can see that's over 4 times or 3.5, 4 times as much. So we're seeing an enormous amount of revenue going into the States, and it's all going into a black hole. And so this is the thing that I think was one of the biggest problems with the Australian property market. The States are into it. Now, at the same time, if you buy a new property, there's GST in that, and the States get to have that 10% GST, which on a new purchase, you'll normally find it's the average of about 6 or 7% of a purchase price. So they're getting 5-6% stamp duty, and on a new home, an additional 6-7% GST. And then, as I'll mention later, they're also getting foreign buyers fees. If you're not an Australian citizen, there's a triple dip. And this is something that really no one is talking about, because people only buy a house every now and again. So you're not in the radar and in the conversation at the often. But this is something as a community we need to be starting to get uproared about, and not only say, why is it so expensive, but where is the money going? It's outrageous. Land tax in the same breath, another state tax, was hardly noticeable back in 2004. In every state, if you own property, there's a tax-free threshold. And what that means is that, most people with normal property back in 2004 were probably underneath the taxing threshold and wouldn't pay land tax, or if they did, it wasn't very much. But over the years, the state government's been very crafty to lift those valuations up quite significantly. Now, it's not based on the value of your property. It's usually based on the value of the land, as if a house was not on it, which gives the valuer general quite a lot of leeway to say, oh, I just think this is what it is. And what we've seen in recent times is those valuations have gone out of whack. Now, if you can imagine, if you own an old house in a nice suburb that's gone up quite substantially, the land tax on some houses in New South Wales, it can be $30,000, $40,000, $50,000, $60,000, and the rent sometimes is not as much as the land tax. But the land tax has become a higher and higher proportion of it. Now, again, there's not much we can do. No one seems to protest. And one of the reasons for that is, in Australia, you do not pay land tax if you're living in the home. So if you are living in that old house in that nice area and it's your home, the land tax is zero. And that's one of the reasons that when you go back to Australia, if you started complaining about whatever your land tax bill may be, nobody understands what you're talking about, because they're not paying it on their properties because they're living in them. Now, that's a good thing, because one day when you do go home, you won't pay it if you move into that property as well as. But what you need to do is be very conscious of what land tax might be. And when you are looking to buy a property, no matter where it is in Australia, make sure you ask the selling agent, what is the land tax value, so that you can calculate it, how much that will be. Now, the other thing you need to be mindful of is land tax is a accumulation tax. The more property you have, the more expensive it becomes. So if you have a property already in, for example, New South Wales, and you buy your second one, what would normally happen is that the first one may have even been tax-free because it was under the threshold. So you may not be aware of land tax, but when you put it on top of the second, all of a sudden you go from a zero land tax bill to maybe $10,000. And that's because the threshold is no longer there. The higher value sits on top of each other and pushes you into a higher rate. So you need to be mindful if you're going to have multiple properties in the same state, that's going to cause you a lot more cost than if you would spread your properties over the width of Australia, because you have a new tax threshold for land tax in each state. But it's something that you cannot ignore when you're acquiring. There's nothing you can do about it, but you don't want it to be a surprise. We've also got a foreign buyer's fee that was not there back in 2004. There's a federal charge of about $5,500, but the state governments have also dived in, and they're now charging foreigners a fee between 7 and 8% across Australia, depending on which state. Now, for most expats, this is not going to be an issue. And that's because if you are an Australian citizen or permanent resident visa holder, you are not charged that foreign buyer's fee. It's only if you are a foreign national without a visa to live in Australia permanently. But the only exception to that rule is New South Wales. So you may be a PR holder in Australia, but you think, oh, well, that's fine, I'm a local. But if you have not lived in Australia for more than 6 out of the last 12 months, New South Wales will still consider you to be a foreigner. So you need to be mindful. Where this catches a lot of people, particularly expats, is your spouse. So for instance, if you're married to an American and you think, oh, great, we'll go and buy a property in Australia together, that will be lovely. You as an Australian expat being a citizen are not charged the foreign buyer's fee, but your spouse, is. So if they don't have a PR visa, they will be charged that foreign buyer's fee in every state between 7 and 8%. If they do have PR, they won't be charged it anywhere except New South Wales. But they'll be charged 8% in New South Wales on their half share of purchase. So if you imagine in New South Wales, it's pretty hard to find a decent property for $1.5 million or 2 million. And if you innocently bought it jointly with your US spouse, then they would be charged 8% on half of the value. So if that was a $2 million property, $1 million being half, 8%, that's an extra $80,000 entry cost, just because you didn't realize and you accidentally bought it. So it's critical that you know what you're doing before. And again, we'll cover all these things. If you come to us for pre-advice, pre-approval on the finance, we'll cover all these things for you. And one strategy you might employ here is that instead of buying it in joint names, you would buy it solely in the person that would not be liable for that foreign buyer's duty. Or if you need that US spouse to be on the loan, for instance, to help get the finance, we only put them on at 5% or 10%, depending what the bank requirement is. So we put them to the least impact rather than on the full half. So it's really, really critical that you think things out. Again, in 2004, free and easy, no worries. In 2022, thought must be done. Thought must be done. And then finally, superannuation. In superannuation in 2004, you had a larger deductible of up to $30,000 a year. Now you've got a smaller deductible of 27.5 max. Now, for you guys being expats, you're not generally going to want to put a tax deductible contribution into super unless you had a profit on your rental property. So what would happen is that you would be advised, that if you had made, say, a $10,000 surplus rent on your property, if you pay income tax, your starting tax rate as an expatriate is 32.5% in Australia, or you could make a $10,000 contribution to your superannuation as a tax deduction to offset the $10,000 of net rental. What that would do is that the tax would now be borne by the super fund at a lower rate of 15%, rather than you pay 32.5 income. So that would be a better scenario. So you want to look at that. The other thing that's really changed, and I think is quite atrocious, is in the good old days in 2004, if you had a US pension, you could quite easily roll that into an Australian superannuation fund when you decided to return to Australia. And whatever amount you had, you could just transfer it down without too much hassle. These days, they've changed the rules to say that those rollovers coming from offshore pension funds, are covered by the new, caps of what you're allowed to contribute in a super. Now, where that's problematic is that you're only allowed now to put in a voluntary contribution of up to $110,000 a year each into super. Now, you are allowed to do a 3-year block. So that's a maximum of 330,000 that you could put in today, and then nothing for another 3 years, and then 110,000 a year or a 3-year block. Now that's quite generous, but if you imagine, a lot of people have pension funds that are $500,000. So what it means is you can't roll over the whole amount. You can only roll over the 330,000 maximum. So you end up not fitting into the jar, which becomes quite problematic. And so it's one of those things you need to think in advance with your planning and look at these things. And again, we're here to help you. It's confusing. You can see the list has got a lot of changes, but there's still a lot of advantages that you can get as an expatriate. So it's not all bad news. But what has changed, as I mentioned, is you really have to do everything with a lot of pre-thought, more than ever. And particularly when you're in the US, which is another layer of complexity, you have to be assessing both sides of the coin. It's much easier, for instance, for expatriates in the Middle East or in Asia, where the tax rates are so low and often there's no capital gains tax considerations and you don't have to declare foreign income. Those guys are still super lucky. You guys in America are very lucky. Apparently you're living in, the greatest country on earth, but that's also bringing complexity because you've got a whole tax regime that you've got to manage between the two. But, there's still good stuff to be had. So let's have a look at what that is. So they're all the things that have changed, some that have been taken off us, some that have been altered, a few, very few for the good, most for the bad. But what do we still have as expatriates? It's still a pretty good gig. First thing we have is that ability to accrue tax losses. Now, this is really, really helpful as a long-term strategy going back to Australia. So what happens is if you own a property in Australia as an expatriate, if you have a mortgage on that property, if you pay the costs and those costs and the interest are more than the rent, then those losses carry forward each and every year and accumulate to offset, as I mentioned earlier, future rental, if you move in a surplus, future capital gains if you sell, or more importantly, future salary on return to Australia. So you still have the ability to say, okay, I'll buy a property now, generate some tax losses, build up a future offset. And what will happen is those losses are going to be a great welcoming present when you go home eventually, and that first amount of income you earn will not be subject to tax because it'll be offset by whatever you've accrued in losses along the way. And I'll show you how easy it is to calculate and build those up in a minute. You've also got way better buying power usually. Now, one of the main reasons a lot of people go overseas is for improvement in their career or their lifestyle or their opportunity to save. In Australia, as we all know, it's still really, really hard to save. If you're on salary, the personal tax rates are lots better than they used to be, but they're still quite high. But the problem is in Australia that it's a lifestyle spending country. We've got used to not saving too much because we've got superannuation of 10% going off here, and we've got the inheritance from mum and dad coming soon. So we don't need to save much. Let's just enjoy it. So let's go on holiday. Let's do this. Let's go there. When I go back to Australia, my friends have got so many TVs and all brand new cars. It's just crazy. But in Australia, all those things are not cheap. When I come to America, I can get a car at an amazing price. I go to Australia, it's 2-3 times the same, price for the same car. It doesn't make sense. But Australians, have got the money. It's the highest net disposable income in the world. So it's every weekly earnings, I should say. It's a really good gig, and everybody's enjoying them. But it's still hard to save. But when you come overseas, if you had a property, it's now rented. Even if you don't have a property, when you buy it, you're going to get rent that comes through that property. And the combination of that rent and your hopefully improved position means that, generally speaking, your budget to buy a property can be larger than if you had stayed at home in Australia. So the trick is to try and exploit that and take advantage of it whilst you're overseas. I often refer to, the biggest advantage for expats being the time machine factor. And by that, I mean, very simply, when you go overseas, you see what Australia will become. You see the society, the culture, and the cost. And if, particularly for you guys in America, you know, I'm sure you've all gone house hunting in America, well, you know, apartment hunting in New York, and it's eye-watering what the cost of those properties can be. But Sydney is going to be the same cost as New York someday. I don't know exactly when, but by the time Sydney becomes today's New York price, New York will have moved to another level. But that's simply a factor of genuine population growth, genuine demand, and, you know, supply being limited. And Australia has those same mechanics. What we have had for many years is a lower affordability rate because people didn't have deposits, but that's changing. Australians have more and more money. They're getting deposits from inheritance. Expatriates are coming home. Foreigners are migrating to the country. So everything is a perfect storm lifting prices up. We were one of the few people that predicted during COVID that we would see the property market do well, where everyone else was saying it would crash 20, 30%. That was never going to happen. And if you're interested, we have a video online that goes through why, but it's purely supply and demand. But the advantage of being an expat is you could go to your favorite place in New York that you totally could not afford today and go, geez, wouldn't it lovely to have this brownstone? Wouldn't it be lovely to have this apartment overlooking the park? Wouldn't it be lovely to do this? Wouldn't it be lovely to do that? And then you go, I can't afford that here in New York. But then you can step into the time machine and go back and look in the Sydney property market, and that same exact type of property in that same exact type of location is going to be a fraction of the cost of New York. And that's what the time machine factor is. You're getting to go back New York 10, 15, 20 years, that if you had bought that brownstone 15, 20 years ago, you'd have made money. If you had bought that amazing apartment with a view over the park, you'd have made money. Sydney is on the same evolutionary track, okay? So you're going back into a market that is still young and immature, but you've seen the future in a market that is mature. Now, if you take advantage of that ability to see the future, then you can make money. If you ignore it, you'll go back to Australia in 10 years and go, oh my gosh, how did this get to be so expensive? So hop in your Doctor Who TARDIS, go back and buy your little bit of property. You know, you've also got the ability that you can get tax-free income on property assets. As an expatriate, Australia will not charge you tax on Australian shares, investments, companies, etc. Now, being in the US, this is not as big an advantage as other places because the US will likely charge you tax on these things. But you could build up a nice share portfolio in Australia, and if you don't sell it while you're in New York, they won't charge you tax. You take it back into Australia, and you will not be charged Australian tax on any growth you have made on your investments, not Australian property, whilst you've been living overseas. So you are encouraged to accumulate and build wealth so that you're improving your situation. And when you take that wealth back to Australia, you will not need to worry about it being taxed. I have so many people say to me, oh my goodness, Steve, I want to send my savings back to Australia. I'm afraid they'll be taxed. That is not the case. Australia will never, ever tax you on your savings. They will only tax you on profits made in Australia. So if you had a great share portfolio that you had bought for $100,000 and it was now worth $300,000, when you go home, it's as if you bought it for $300,000 being the market value on the day of arrival. Now, if you sell it for $301,000 a couple of weeks later, you'd only be taxed in Australia on the $1,000. Now, again, we'd have to look at the US issues. Hopefully you sell it in the next financial year in the US, so it's not taxable there either. But it means that you can save with confidence, knowing that you can take that wealth back and get it tax-free in Australia on your return. Now, the key is also you've got the ability to plan. You've left for a purpose. You have to recognize that purpose, and then you have to start thinking, what is the main motivation to be here? And I've spent my entire career nagging people to at least buy their future home. You want to come back to Australia and live in the place you want to be, in the house you want to be in, and enjoy it at the lowest possible entry price, which is always yesterday's price, not tomorrow's. So the sooner you think, what does my future look like, and start putting the pieces in place, such as investing, such as buying a future home, such as accumulating. It's great. One of the things that I've always said is the experience of being an expat is not enough. You have to make sure you're getting better off. What I want to show you is something that usually shocks people as to how affordable it is to buy and keep a really good property in Australia. So what I'm going to do here is I'm just going to show you the mechanics of what your tax return would look like and what your ownership would look like if you bought a property in Australia as an expatriate. Now, in this case, I'm going to spend $1 million. Now, that will obviously depend on where you buy, what you buy, you know, whether it's an apartment or a house in New South Wales or Tasmania. But I'm just going to use that as an example. Now, this tax estimator that I'm going to share with you, it's our own personal model. We built it. So if you are thinking about buying a property, just drop us a line, tell us how much you're going to spend, and we can prepare it for your personal circumstances so you can see what you're going to be in for. But normally when I say to someone, oh, look, you're going to buy $1 million property, how much do you think it's going to cost you to keep it? They go, oh, it's going to cost me at least $30,000, $40,000, $50,000. The interest rate's high. You know, it's going to be expensive to keep. And they're quite shocked that when they realize that they got the tenant helping out and the interest rates are now so much lower than they used to be, look how a difference it makes. Now, in this particular case, I'm just using a general example, but if you bought $1 million property, you know, you would likely get in most places in Australia at least $35,000 a year in, you know, in gross rent. Now that's a little bit on the soft side. Rents are quite strong now that COVID's rebounded and everything's there, and particularly in the housing stock. A lot of people say to me, "Oh goodness, I'm worried about buying a house because they're not as easy to rent as an apartment," and that is complete bollocks. You know, any good property is easy to rent in Australia. We have some of the lowest vacancy rates in the entire world. The things that are hard to rent in Australia are things that aren't very livable. So during the last, say, 10 years in Melbourne in particular, they've been building lots and lots of high tower, very, very teeny weeny apartment. We call them stops, small, tall and overpriced. And we've been warning people not to buy those for a decade. And largely because they're not what people want to live in. They'll stay there like a student out of necessity, but it's not a high demand asset. Whereas if you had bought a proper house, a proper townhouse, a proper apartment that was good size, good location, good view, they've done fantastically well, where the stops have gone backwards 10, 20, 30%, especially because of COVID. You know, during COVID in Melbourne in particular, you know, those stops, you know, small apartments were occupied by students, and during COVID, the students all left. So that left an glut of all these, you know, apartments that are genuinely not livable. So rents declined and vacancy skyrocketed in that sector. But everywhere else, there was stability and sensibility and a little bit of rent rise because people needed good sized living accommodation and they didn't want to live in those things. So everything is good and rentable across Australia. I don't have any fears with that. The population is still growing, notwithstanding the borders being closed, but they do open on the 21st of February. And I think you're going to see another surge in the Australian property market because of that, because now we're going to get population growth because of our traditional incoming migration as well as natural births. But in this case, 35,000, no problems renting it. And when you get $1 of rent, what that means is you now have an obligation to lodge a tax return. And this basically is what your tax return would look like. So you have to declare the gross rent and then you get to deduct off all of the expenses. So, you know, the property management fee in Australia is about 6% odd. Very easy to look after your property, very simple. They pay all the bills, do all the work. They just send you the net rental. It's nice and easy. Tax return fee for us, 400 Australian dollars. We even give a 20% renewal discount after your first year. And we look after everything, and that's a one-off fee included of any general advice. A little bit of repairs and maintenance every now and again, council rates, and again, you need to look and see if there's any land tax issues, and that will be a case-by-case scenario. It'll depend how many properties you own, in which state, so you need to check that prior to acquisition. And if you have a property now and you're not being charged land tax, I would strongly recommend you contact the state government and just double-check that you are under the threshold. There's a lot of people that the state governments have not yet caught up with that have land tax bills, but they don't know where you are. They don't know where to send. They forgot to send. They think you're living in the property. And we're getting a lot of clients that get smashed by back tax on land tax. And believe you me, the state governments are brutal when it comes to penalties and catch up. They are unforgiving. So you don't want to be on the wrong side of that. Make sure you check what your obligation is. Allowing for insurance. In this case, I'm assuming it's a house, so the insurance is a bit more expensive. In an apartment, the insurance is quite cheap because it's included in the body corporate. But in this case, we're going to go borrow 80% of that $1 million, so 800 grand. And you can currently, as an expat, get a loan of 80% at 2.84%, which is pretty damn good. Like I say, most of my career, it's always been above 5%. So I can't believe my luck at 2.84%. But you can see the interest on that would be $22,720. So all of your costs of ownership of that property are $31,930, roughly 32 grand. The rent is 35. So this $1 million property with an $800,000 loan is actually not losing money. It's actually making a surplus of $3,000 a year. So your holding cost is not anything. You're actually making a profit on a typical transaction. Now, if that was an old property, you would be taxed on that $3,000 profit. So what would happen is you'd have 32.5 cents in the dollar tax on that. So your Australian tax liability would be roughly $1,000. So if it is an old property, then that's where it would stop and you'd pay a little bit of tax. So that's where I would probably make a $3,000 contribution to my super to nullify that back to zero. But if you had bought a property that was built after 1995, then you get depreciation allowance on whatever it costs to construct that property at the rate of 2.5% of the original cost. Now, if you bought a brand new property, that would be roughly about, 14 grand. I forgot to change my 270 there, my apologies. So it'd be about 450 grand would be the building cost on this. And then if it was brand new, you'd get depreciation on the carpet and the stove and all those bits and pieces. Now that's a write-off about 15% a year. But if it was a second-hand property, if you bought my property off me, you would not get the depreciation on the carpet and the stove and all those things. Only you'd get that if you ripped out the old kitchen and replaced it, if you ripped out the old carpet and replaced it. So if you do the work new, you'll get those depreciation benefits, but they will not flow from the previous owner to the new owner. But the building write-off does. And then you can write off your borrowing expenses over 5 years and then a little bit of telephone and stationery. So you see what that's done is even though we made a cash profit of $3,000, if it's new or near new and we've got those depreciation allowances, we've actually got a tax loss of $15,000 each year. Now, because we're in a loss situation, the tax on that each year is zero. If you don't have a $1 of profit, there's no tax to pay. But that $15,680 carries forward to the next year and says, okay, have you got any profit this year? No, you've got another 15,000 loss. Great, we'll carry forward 30,000, then 45, then 60. So if you imagine very quickly that 15,000 is building up as a future tax benefit to offset future income on the rent, future capital gains on the sale, or more importantly for me, future salary in Australia. So if I own this property for 5 years, I'd have $75,000 of tax losses built up, even though I had made a profit on the ownership of 3 grand a year. So I've got a $75,000 tax benefit, what we call tax credits, and I haven't even had to pay for them. I made $15,000 for the privilege. Now, the great thing is, if I go back to Australia on a salary, my first 75,000 of salary will be effectively tax-free because I'm using up those losses. So if I go back and I'm earning $300,000 a year, I'm going to recover those losses at the maximum rate of 45 cents in the dollar income tax, plus another 2% Medicare that I'm back in Australia. So I'm going to save 47 cents in the dollar on that 15,000. So potentially, I'm going to pick up about $7,500 as a future tax refund. So if I've got $3,000 profit from the rent and $7,500 future income tax benefit on my salary, I'm 10 grand a year better off straight away just on buying that property. So it's surprisingly affordable to buy a good property when you're living overseas because it is rented and the tenant is picking up all the burden and the tax man works in your favor, particularly if it's brand new. Now, this is usually quite a revelation for most people because conceptually they're thinking, oh my goodness, it's going to cost me a lot if I do it. Now, the one thing that you will want to note though, is that if you take this loan, these days it's best to take principal and interest. So you're reducing the debt each year, okay? Now, you do that because it's cheaper now to go principal and interest than if you went interest only. In the good old days, we always said to people, go interest only, save the money to the side, pay it off at your discretion. But these days, they make it cheaper to go principal and interest than interest only. So we're always going to recommend you go for the lowest cost unless it's going to affect your cash flow. Now, in this particular case, if you had that $800,000 loan, you'd have a $3,000 profit, and that's covering the interest. But there would be another cash flow cost of $16,900 being the required repayment on the loan under the principal and interest. But the good thing is that $16,900 is not really a cost because it's lowering your loan. It is a cash flow issue. You've got to be able to afford it, but you've got $3,000 spare. So you can see that $3,000 is going to, mean that outlay from your pocket to own that property will be around about $14,000 a year, including $17,000 of debt reduction. Now, when you factor in the future tax benefit, that's all great, but that's very, very important that you do that. Now, one of the things that you're not encouraged to do is pay the loan off any faster than the bank requires you to do so, because then you'd be lowering your tax benefits and you'd be increasing your profits, etc. So if you end up with a situation where you've got too much surplus on an old property, where the loan may be very low and the value's gone up and the rents have gone up, then the advantage here is that in Australia, you're not taxed on the individual property, you're taxed on all of your properties together. So what you want to do is go and say, okay, I've got a profit on this one, let's go buy another one and have a loss on that, and the two combine and nullify each other out. So it works very, very well. Now, to have a look if it's still worthwhile financially, here's a very simple example of that same property, and let's look at it in 5 years' time as if we sold it. And what I'm doing here is showing if you paid cash, borrowed 50 or 80%. Now, in this situation, you can see it's $1 million entry plus the $52,000 cost. Obviously, if I pay cash, I've got to put all that money up front. But instead of having a $3,000 rental, I'll have a $25,000 net rental because I don't have the interest cost. So I make 128 grand over the five-year period, and my income tax is only 11,500 because I've got those depreciation benefits knocking it down. So my total investment over 5 years, 930 grand. At 50% with the adjustment of half the interest, I get 57, but I've got no income tax to pay because those depreciation allowances are enough there. But I'm not carrying them forward to much to offset my tax on the capital gain. And in the 80% example, you can see obviously I've put less money in at the start, but I'm making less money in rent. But I've only put 237 grand over 5 years to own $1 million property. If I sold it in 5 years, and I've just for the sake of argument used a 5% growth. Now, traditionally I'd use 7. At the moment, some of the markets in Australia are all doing double-digit growth. So we can put in whatever number you think, but I'm trying to be conservative here to just show an example. Obviously, anything above 5% is going to give you a better return, but 5% being a very conservative level, if you had paid cash, that 5% growth after income tax, after capital gains tax of 97,000 is 4.4% annualized return. Now you can see when you borrow, that doesn't affect the sale price. The property will grow at the same rate whether you borrow or don't. All that affects is the net rental that you receive. But you can see if I sell it for 1.276 with a 50% loan, I've got some of those tax losses to carry forward. So my tax drops from 97 to 84. And if I borrowed 80%, I've got even more tax losses. So my tax drops to 69. But okay, that's still a large amount, but over the scheme of it, you can see my return on funds invested goes from 4.4 to 10.96. So 10.96 after tax, income and capital gains tax excluded, is still a very, very attractive return. But where I see this as being such an important strategy is if you imagine this was your future family home, you're likely not to sell it, so you don't have to worry about the capital gains. But importantly, if in 5 years' time, if you bought this today as your future family home, when you go back, the value is now 1.276, but your cost is still only $1 million. So that $250,000 of gain is yours in your back pocket that you will never have to pay for. If you procrastinate and say, look, I'll buy my future home when I go back in 5 years, then you're going to pay at least 1.276 for the same property that you could have bought $1 million today, which means you need another 270 grand of savings to be, going towards it, helping you reduce it, helping you be debt free. So you see, critically, you become, much, much better off if you roll the dice, get a nice property, especially if you could live in it, bank that profit, borrow that money, low tax, no tax, everything works beautifully as an expatriate, just as much today, even with all the adverse changes, as it did all those years ago. So 10.96 after tax on a 5% growth is an extremely attractive number. And if the market does do what it currently does, then that 10.96 increases quite substantially as we go to 6, 7, 8, 9 to 10% growth. But I would caution people not to expect that great growth every year. I think that would be unrealistic. Let's have a look at some Americanization issues for you guys, because everyone asks us those things. And the big thing for you guys is that in America, once you arrive, you get taxed on any profits if you sell assets, regardless of how long you've held them and what you bought them for, in full in the US. So you've got to be very careful if you've got shares, property, anything like that. Even if you just arrived in America, if you sell it, you'll pay tax all the way back to the start. So you've got to be very, very mindful of that. You've got to look at all your foreign income declarations. It's very, very complicated. Can't give any general advice there because it really depends on your situation. Are you a resident alien, a non-resident alien, a full green card, non-green card? But make sure you get good advice, and we've got help that can give you with that. When you're going back, one of the big things a lot of people don't realize is if you do cash out of your 401k, you've obviously got income taxes. But if you're under 59.5, there's also an additional 10% penalty for you to cash out if you're not at 60. So be mindful that if you're putting money away in 401k now, try and make sure you're putting money that you don't need until you're 59.5 or older. So make sure you're mindful of that, and you've got idea of long-term purpose. There's exit issues now in America. There's an exit tax, they call it, and that applies to anyone who takes up citizen, has a green card. But for green card holders, it's if you've been in America 8 out of 15 years. So you want to also be mindful in the back of your head as to how long have you been here? Do you have that exit tax? What that basically is that for you to be relieved of the things like inheritance tax, capital gains tax, etc. in the US, when you leave, they make you pay whatever's due at the time of departure. Now, this won't apply if you've been a green card holder for less than 8 out of 15 years, or if you're just on a temporary visa. But you need to be mindful of this, because what does happen in our expatriate lives, we tend to come for 2 or 3 years and we stay for 7 or 10. So you'd be surprised how quickly you crawl up to 8 years, and then all of a sudden you're now in the danger zone. You've got to remember, if you do stay as a US citizen or a long-term green card, you may be taxed on worldwide income when you leave. That's not such a big issue for most Australians, because the Australian tax rates are similar to the US tax rates, so they do nullify out, with foreign tax credits. But where it does become a problem is if, say, you wanted to take a detour back through the Middle East or Asia, the US will still charge you US tax rates, even if you were tax-free in Dubai, for example. So you just need to be thinking about where is your next stop. And you've also got to be very mindful when you're doing your tax returns with foreign tax credits. We have a lot of cases. I had one the other day where a client hadn't lodged their Australian tax return on their Australian rental property, and they've been lodging it, correctly in their US tax return and paying US taxes. Now, the problem is that he still has an obligation to lodge in Australia, and Australia will tax him. Now, normally, if he's paid the tax on that rental in Australia, he'd lodge it in his US returns, and you'd get a credit for the Australian tax as an offset against whatever the tax might be in the US. But because he has lodged US first and not Australia, when he now goes and catches up his returns, he'll pay Australian tax. Australia does not give a credit for what you paid in the US, and the US will not let you go back too many years and put that credit claim back in. So he's going to end up having to pay double the tax where he would have only had to pay one. So you've got to be very, very conscious in the US as to make sure you've got everything done properly and on time, and those credits are in the right place in the right years, so that you're not trying to claw them back. There's some of the key issues. Obviously, there's other things that you want to look at, personally. But one of the other things I always worry about my clients is you've got to get off that mustard. Get back on a ketchup. It's going to be hard. You just book yourself in a rehab and you'll be right. Okay. Now, just key expat strategies. What are they? Well, pretty simply, whatever you do, look at where you're going to live. Try buy that future home, as early as you can. And again, we've got so many clients that, are so appreciative that we push them in that direction, because literally they would not be able to afford their homes today. All that growth, they've benefited now as personal wealth rather than entry cost. So the sooner you do that, getting those tax advantages, locking that in, the more clarity your future has, the better off you are. Now, don't worry, you might change your mind. You might buy this as your home and then you got a bigger one later. But if you buy it as an intention, you'll buy smart, you'll buy wise, it'll do well, and then you just keep those assets. Whatever you do, try not to sell, until the latest time. If you buy now, you get the entry price. Try and sell as late as humanly possible, because it'll be worth more. So even if you make a mistake and you thought, oh, this will be my home in New South Wales, but you end up moving to Victoria, the fact that you bought it at yesterday's price, when you sell that at today's price, you'll have enough money to go to the next destination. But doing nothing is dangerous. One of the big things, as I mentioned earlier, please, if you've been living in your home previously when you're in Australia and you've moved overseas, please, please, please do not sell it while you're living overseas, because you will not get the tax-free portion. You only have to wait till you move back home. You're far better to release the equity as debt rather than as sale, and it's just a matter of patience and planning. And again, we'll help you do all that. This does not apply if you never lived in the property. Okay, that's just a normal tax situation. This is only an issue if it was ever your former residence. If you never lived in it, doesn't matter. If you did live in it, please don't sell it while you're overseas. Wait till you've moved back to Australia. Again, you don't have to move back into the house. You just have to move back into the country. So make sure you keep that for as long as you can. Take full advantage of that buying power. Like I say, it's going to be surprising to you how affordable it is, because you're overseas, because you've got a tenant, and because of the fact that, you've got capacity to do so. So, stump up, go a bit higher, push your boundaries, genuine 20% equity, 5% for costs. And that can come as cash, or it can come as equity in an existing property. So if you've had a property in Australia for many years and it's gone up in value, you can use that extra as your deposit on your next one, and you should do so. Always try and buy your home first, especially now, because even though finance is available, it's harder than it used to be to get. And so you will not get the same level of borrowing that you could in the past. So you need to be careful that if you buy too many investment properties and then you finally see the perfect home for you, the bank might say, no, you can't have the money for that because you've already bought these other two and you've maxed out your capacity. So just always try and get your home first, and then investment properties are easy after that. Get those tax credits. You'll never regret having too many of them. Probably the biggest complaint that I get from my clients is, Steve, why didn't you make me buy more property and get more tax credits? Because I've used them all up already and I'm now paying tax again. It is fantastic to be able to do that. It's a great asset. It's a terrific thing that when you go home, you can, enjoy many years of tax-free. If you're going back, what you do need to do is get valuations on any retained assets. So as I mentioned, your property in Australia is always taxable, but everything else is not taxable in Australia. So if you go back, what happens is you need to get a valuation on anything. So if you've got a New York property that you bought, you don't need to sell it, but you'd need to get it valued. And the higher the valuation, the better, because in Australia, when you eventually sell it, it will be subject to capital gains tax, but only on future profits after the date of arrival above that valuation. If you had shares, they're obviously easy to value because of the fact that you just check what the stock market price was on the day, and then boom, away you go. But that valuation is critical, so make sure you get that done. And he says, an optimistic price. And then just remember, there's a purpose you're overseas. Save as much as you can. COVID's been, for want of a better word, kind to us insofar as the first time that we weren't allowed to live the lives that we wanted to. So most expats spend a lot of money on travel, and that's something that we haven't been able to do. So hopefully you've got a few extra coins in the tin. Hopefully you've changed your habits a bit. Hopefully you don't go crazy and blow all that as soon as the airport's open. But just remember, the purpose here is to try and get home low or no debt. So if you buy that $1 million house, that's step one. Step two is, how do I save the $800,000 to pay it off when I go home? And if we do that, you'll never have a problem living in Australia with a modest income and a zero or modest mortgage. Life is happy, all good. And whatever you do, just get off your butt, do something. I still think we're one of the luckiest people on earth, but the one thing I have learned in regards to luck is worthless without action. So do something, go and find the property, invest wherever it is, even if it's in the US, if it's in Australia, regardless, just do something. Something is better than nothing. So invest now. Don't pay down your loans any more than you need to. Go chase, other investments, especially because interest rates are low right now. So you might as well pay 2.84 and then go and invest and make 5, because you'll be better off overall. And whatever you do, please remember that because you don't get that 50% tax-free whilst living abroad, when you go home, one of the strategies you want to do is own that property for as long a period of time that you're living in Australia, because more and more and more of it becomes tax-free every year that you're back. So don't try and rotate, try and be a holder, hold for as long a period as you can be in Australia, enjoy more of it capital gains tax-free eventually. So sell when you need to, sell late as possible, and you'll be happier than normal. Hopefully that's given you a pretty good idea of a lot of things. We've covered a lot of ground there. I'm really, glad to present that for you. And again, we're available to assist. On that note, I'm just going to thank, the guys there at AAA. It's terrific to get involved with you, and you've done a terrific job putting this together. And Julie and my support team. And, I'm all finished, and I'll happily take some questions. So thank you very much, everybody.
Thanks so much, Steve. There was a lot of information there, and I'll try and get through. I'm conscious of time, but we've got a few questions which we can run through quickly with you. And just to let everybody know, we will, for other questions that came through, we'll answer those in a follow-up email tomorrow. So don't panic if we don't get to you tonight on the webinar. Just a first question. If I inherit a part share of a property whilst living in the US, and that property is then sold by my siblings, is tax payable? And a follow-up from that, if I inherit a portion of property assets while in the US and my siblings want to sell the properties, how long do I need to return to Australia to be considered living back in Australia to reduce capital gains tax?
Yeah, look, you have to return permanently, so that's never an option. It's, unless it just happened to coincide with your return, don't think you can go back for the weekend or a month and say, oh no, I'm a resident, it's lower tax. So that's just a fact of circumstance. But the good thing is that, with inherited property, it just depends on two things. One, was it a residence or was it an investment? If it was a residence, so it was your parents' home, for example, and that's now passed to you and your siblings, then the law says that you're deemed to acquire that property at the market value on the day of their passing. So what happens is that if you sell it soon after, the tax implications are likely to be nothing or very small, because you're selling it within a few months or so of when they passed, and therefore the valuation hasn't changed much. If it was an investment property, it's as if you were the original owner. So it's as if you had owned it for the 10, 15 years that your mum and dad had. So it's just one of those things. You need to know what was the property, what was the original cost, and then we can just work that out for you. But there's no way that you can easily reduce it. But, the simplest way I say is, if it was an investment property, you inherit the property, you inherit the tax. If it's their residence, you just inherit the property, and it's only future tax you have to worry about. But, obviously consider buying your siblings out, because what that might be is a chance for you to say, look, I own a third or a half. You want to get rid of it, I might keep it. It's a good investment. You've got a deposit being your inherited equity. So what I'd encourage you to do is consider, can we buy them out? If they want to sell it, why not sell it to you?
That's great advice. Here's another situational one. I live in Australia, but am in the US for much of this year. I have bought an off-the-plan property which settles in December 2022. What are rules around considering this property as my primary residence and pay no capital gains tax? Do I need to live in it, and for how long?
Yeah, you do need to technically move in, and particularly you want to, in a perfect world, you want to be the first person that lives in that property. So what happens is if you are the first person that lives in it, whether it be for a month, 6 months, or a year, then it triggers the principal residence, and then you also get the benefit of the period you lived in it plus up to another 6 years if you don't sell it until you're back in Australia eventually. If you are not the first person that lives in it, then it's always going to be pro rata taxable. So for example, if it comes to maturity and you settle and you rent it out straight away and you rent it for 2 years and then you go back and you live in it for 8, that first 2 years will always be subject to tax. So you'd always have a 20% out of 10 years of tax. But if you can be the first occupant, that's it. Now, what you do need to do is obviously be in Australia, utility bills, all those sorts of things. There is no official how long you have to do it. So it's not really a question of how long. In theory, it should be around 6 months. But, as long as you can prove that, one, you were physically there, and two, it was your property, i.e. you ideally want to move furniture in, electricity turned on, etc. The fact that you then got an offer you couldn't refuse to go back to New York a month later, that wouldn't remove that principal residence period.
Great. Could you, Steve, clarify the proposed residency rule changes, and do you believe that they'll be introduced in the March budget announcement?
I wish I could, but I can't because we have not seen the legislation. We put a petition together, and did a lot of activity around this, and we were fortunate enough to have over 5,500 people sign our petition. So I'm hopeful that's one of the reasons why we haven't seen the draft legislation, because that hopefully was a bit of a showstopper. It was announced in the previous budget. We may see changes. We are literally waiting for legislation. But we are also maybe waiting to see if the government gets back in. They're not looking too good right now. So it is going to be a suck and see situation here. I don't think it's going to affect most expats, and particularly if you're in America where there's a double tax agreement, you shouldn't be overly impacted by the changes. But until we see the law, we can't be absolutely sure. The proposal is that if you're back in Australia for 45 days in a year, they may be able to treat you as a resident. But the double tax agreement, I believe, would overwrite that unless you were back in Australia for more than half of the year. So as long as you're in America for more than 6 months, the double tax agreement, I do believe, will overwrite the changes. So I don't think things will change so much for you guys, but we'll have to wait and see what the law says.
Yeah, time will tell, I guess. It's an exciting year as we all watch Australian politics.
More for the list.
Is a dual citizen exempt of taxes such as land tax, capital gains tax, and inheritance tax?
Absolutely not.
Okay.
It's irrelevant whether you're a dual or not. You could be a Martian, they're still going to tax you.
Okay, that's a succinct answer. A particular Australian state announced it is considering calculating land tax on properties owned in other states. Do you think this is likely to come into effect?
Sadly, yes, and the state in question is Queensland. Shame on them. So again, this is the point I was trying to raise earlier. There is a whole underswell here of land tax, stamp duty, where the states are getting away with blue murder, and you can see even in New South Wales they're talking about merging, the stamp duty on acquisition to make it more affordable for people. They're talking about saying, oh, look, we'll charge you annually a smaller amount rather than a big one up front. But, no one's asking the question, why is it so expensive? Why are you taking this money? Where is it going? What are you doing with it? And for me, the Queensland, for them to impact that, one, I think is foolhardy, but it just shows the lack of respect Australia has generally for anyone that has accumulated anything. There's always this, and rightly or wrongly, it's not an issue, but everyone thinks that if you've got money, you should pay more. And I'm not a subscriber to that. I think, you're already paying more because you made more money. So to me, we just need to get, organised as a lobby group the property councils, expatriates. You know, we need to coordinate because there's no one arguing these issues and protecting, you know, general investors and particularly us overseas. So we need a more coordinated approach.
That's great. Thanks, Steve. Any kind of final remarks before we wrap things up?
Oh, look, it's just, you know, it's interesting times we live in. I think, you know, if anything, one of the reasons made us so lucky as Australians is the fact that we can go back to that country. And with all of its failings, you know, it's still pretty blooming wonderful because let's face it, where is perfect? There is no perfect anywhere on the planet, but Australia, I reckon, is as close to the mark as most. So the fact that we can go back and enjoy that in a culture that is caring, in a culture that, you know, has sensible, you know, governance and general prosperity, I think is a thing that we all take for granted. And hopefully with something like COVID, we've probably developed a different level of appreciation, you know, and maybe, you know, it refocuses us. But, you know, it's a great family environment, and that's why most expatriates go back. It's still very, very well priced for what it is. So, and this is where I think that, you know, in the future that you need to get your property now because, you know, people with money are going to realise that the nicest place to live is Australia. You know, you're protected with health, you're protected with environment, you're protected with economy, you're protected with rights, you know, and I think it's going to become, you know, more and more of a popular little fantasy island. So get your share of fantasy island before the season ends. That's all I'm trying to say.
You heard it here first. Get back to Australia. Thanks so much, Steve, to you, Julie, and the whole team at SMATS for sharing so much incredibly useful information with us this evening. And thank you to all of those who have joined us. We do invite you to join us next week on February 24. We partner with G'day USA for commercializing climate innovation, innovating our way to net zero, where we have a panel of experts in the climate field. And we've got an exciting program of events for 2022, so keep an eye on the AAA website for further details. If tonight has raised further questions for you, please do reach out to Steve and the team at SMATS. We will send up a follow-up email tomorrow, a replay of this webinar, as well as some answers to the questions that have come through and details of how to get in contact with SMATS. So thank you for joining us. We look forward to seeing you again soon. And thanks again, Steve. We really appreciate what you've done tonight.